Dow Theory is one of the oldest technical indicators in the stock market, and it's still fairly accurate and relevant today at predicting a bull market or a bear market. The theory adheres to 7 basic principles. Now don't worry, I'm going to go over these principles in more detail, but here's a quick summary. First principle, price discounts everything. Second principle, there are 3 trends in stock prices: primary tide, secondary reactions, and minor ripples. Third principle, primary tides going up, bull markets, usually have 3 up moves in stock prices. Fourth principle, primary tides going down, bear markets, usually have 3 down moves in stock prices. Fifth principle, the Dow Jones Industrial Average and the Dow Jones Transportation Average must confirm each other. Sixth principle, only end of day closing prices of the Dow Jones Industrial Average and Dow Jones Transportation Average are considered. Seventh principle, the primary tide remains in effect until a Dow Theory reversal has been signaled by both averages. The first principle is price discounts everything. And what this principle is stating is that we're only going to focus on the price and its movements to determine whether we are going in a bear market or a bull market. We're not going to focus on what we hear in the news, in the media. We're not going to care about what companies merge with other companies. We're not going to care about rising or falling interest rates or hot tips that we hear in the trolley. All that stuff is important, but the notion is that the market is so efficient, by the time you hear about that news, it doesn't matter. It's already been focused into the stock price. The second principle is that there are 3 trends in stock prices. The first trend is a primary tide. This is the major long-term trend. The second trend is secondary reactions. These are the intermediate term corrections that interrupt and move in the opposite direction against the primary tide. And the third trend is ripples, and these are the minor day-to-day fluctuations. They're not really a concern when we're looking at the Dow Theory. So to better understand this principle, let's look at an example. Looking at the Dow Jones Industrial Average in this example, it's pretty obvious to see that it is moving in an uptrend. This is a primary tide. The secondary reaction is an intermediate correction to the primary tide. It moves in the opposite direction of the primary tide for usually between 3 weeks to 3 months, as you can see here. Finally, we have the minor ripples. These are the day-to-day fluctuations appeared here and are not really a concern to us. Principle number 3 states that primary tides going up usually have 3 up moves in stock price. The first up move is known as the accumulation phase, and this is a product of far-sighted investors realizing that the market, which may have been underperforming at the time, will improve. The second move up is known as a market phase, and this is a product of growing recognition that fundamental business conditions will improve. The final stage is known as the speculation stage, and this is the product of mass hysteria. They're seeing this news, they're seeing the stock going up, nobody wants to miss out. This is actually a dangerous time to buy a stock, because usually this is when you're at the market bubble and the stock is going to drop down. Principle 4 states that primary tides going down, bear markets, usually have 3 down moves in stock price. The first move down is known as the distribution phase, and this is a product of the far-sighted investors realizing that the market is over-optimistic, oversaturated, and can't contain its positive momentum. It's a product of them selling the stocks with this realization. The second move down is known as the shock and fear phase, and this is the product of growing recognition that fundamental business conditions are not as optimistic as originally hoped. And the final move down is known as the distress and disgust phase, and this is when people are panic selling. The market is going down, they're just disgusted, they want out, and they sell their stocks for really anything. Principle number 5, the Dow Jones Industrial Average and the Dow Jones Transportation Average must confirm each other. The Dow Jones Industrial Average and the Dow Jones Transportation Average are 2 index stocks. The Dow Jones Industrial Average, as you see here, is comprised of 30 of the largest stocks traded on the New York Stock Exchange and NASDAQ. And the Dow Jones Transportation Average is comprised of 20 of the largest stocks that are sold in the transportation sector of the NYSE and NASDAQ. The Dow Jones Industrial Average is thought to be a measure of the overall consumer goods in the market, and the Dow Jones Transportation Average is thought to be a measure of the overall transportation sector in the market. The principle that the Dow Jones Industrial Average and Dow Jones Transportation Average must confirm each other is based on the belief that if one was to rise or fall, the other one would follow shortly in the same direction. For example, let's say that there's less demand for consumer goods. We know that the Dow Jones Industrial Average, as it is a measure of the overall consumer goods, would fall. But by this theory, the Dow Jones Transportation Average should also fall. And that's because there won't be that need to transport the goods, and that will affect the transportation sector. And vice versa, if transportation goes down, they won't have the means to get the goods to the consumers, so then the Dow Jones Industrial Average would also fall. Principle number 6, we're only focusing on the closing prices of the Dow Jones Industrial Average and the Dow Jones Transportation Average. So we are not considering the intraday high and lows, we're just considering the price that it closes at the end of the day. Principle number 7, the primary tide remains in effect until a Dow Theory reversal has been signaled by both averages. For a bull market, a reversal is signaled by the market's inability to reach higher highs and higher lows, and for a bear market, a reversal is signaled by the market's inability to reach lower highs and lower lows. Now let's review these principles for an uptrend. If you remember our first principle, it's that price discounts everything. And that's what we see here. We're only focusing on the prices of the Dow Jones Industrial Average and the Dow Jones Transportation Average. So we're not looking at any other factors. And if we jump to principle 6, we'll remember that we're only focusing on the closing prices. And that's what all these points here. These are closing prices from around November 2019 to December 20th. December 2020. The second principle is that there are 3 trends. As we can see here, after this bear market, it's quite obvious to see that there's an uptrend, and that is our primary tide. We can also see a secondary reaction happening for both the Dow Jones Industrial Average and the Dow Jones Transportation Average. And then, of course, all the day-to-day fluctuations are the minor ripples. I didn't depict them in this example, but they are there. We can also see the third principle here, and that is that uptrends usually have 3 price moves up. After the COVID drop, we can see the accumulation phase happening here. The smart money is now buying stocks because they realize that this pessimism right here cannot hold up forever. After the accumulation phase, we see the market phase, and this is the general public realizing that the market isn't as far gone as it was initially thought to be. There's now some optimism. And finally, we can see the start of the mass hysteria phase, or the speculation phase, and this is everyone now realizing that the market is going past, it's actually going past the high that it fell from from COVID. And so people are getting more comfortable now in purchasing stocks. Now that we have an understanding of the Dow Theory, what is a practical strategy that we can use or apply to the stock market that's rooted in Dow Theory? Well, there's 2 strategies I've found that are effective. The first strategy is to buy the Dow Jones Industrial stock when it rises to a new 9-day trading high, and it's confirmed by the Dow Jones Transportation stock rising to a new 39-day trading high. You're going to sell the Dow Jones Industrial stock when it falls to a new 22-day trading low and is confirmed by the Dow Jones Transportation stock falling to a new 166-day trading low. The second strategy is to buy really any index stock when the Dow Jones Industrial Average and the Dow Jones Transportation Average cross above their yesterday's 3-day exponential moving average. If you don't know what an exponential moving average is, I will provide a link in the description of this video to explain that concept. Once you buy the stocks, you're going to wait for the Dow Jones Industrial Average and the Dow Jones Transportation Average to cross below their yesterday's 3-day exponential moving average. And when that happens, you're going to sell.